Welcome, everyone, to this explainer. Today, we're not just looking at the current economic climate as some random, isolated headlines. No, we're looking at it as a massive global chain reaction. Think of it literally like a giant puzzle, or a true domino effect, right? Where a single policy decision on one side of the world just tips over a sequence of market reactions everywhere else. We're going to map out exactly how rates, markets, and the broader 2026 global economy are all intricately connected. But first, let me ask you a question. Have you noticed how everything lately, from broad stock market trends right down to your daily consumer costs, kind of feels like it's caught in this state of suspended animation? It's like the entire global economy is stuck in a massive holding pattern, just waiting for a signal. Everyone is watching, waiting to see exactly which way the scales are going to tip next. Okay, let's dive right into this. We'll start off with the high-rate era, look at how central banks are holding steady, and see how global markets react. Then we'll zoom out for the 2026 economic outlook, and finally wrap up with currencies and commodities. So, part one, the high-rate era. To really understand everything else happening in the markets right now, we absolutely have to start with the first domino, the pervasive global environment of high interest rates. You've probably heard this phrase thrown around a lot lately, but it is totally foundational to what we're talking about today, higher for longer. That's the current monetary policy consensus. Essentially, central banks are keeping interest rates elevated for an extended period because, well, inflation is proving to be incredibly sticky. So what you should take away from this is pretty simple. The era of cheap, easily accessible money, yeah, that's officially on pause. The main goal here is to wrestle inflation back down to target levels, and doing that requires keeping the financial brakes pushed all the way down. Moving to part two, central banks hold steady. So who exactly is applying these brakes? Well, it's our major institutional players. And while these major banks are all officially holding their rates steady, their internal pressures and underlying stances vary widely. Just look at the U.S. Federal Reserve at the top there. Under the new Fed chair, Kevin Warsh, they're maintaining a very cautious, hawkish hold between 3.50% and 3.75% because inflation is still running just slightly above their target. Then look at the Bank of England in the middle. They're holding at 3.75%, but there is some deep internal division going on. Two committee members actually voted for a hike to 4.00%, citing some major concerns over persistent price pressures and wage growth. Finally, the Reserve Bank of Australia at the bottom is sitting at 4.35%, and markets expect them to hold that right through the third quarter as they keep a super close eye on services inflation. So they're all holding, sure, but the tension behind the scenes, totally different for each institution. Which brings us to Section 3, Global Markets React. Now, these central bank decisions don't exist in a vacuum, right? They act as an immediate catalyst, and they're creating this fascinating tale of two completely different market reactions. On the one hand, Wall Street has seen some really solid gains. The S&P 500 and the Nasdaq are moving higher, largely driven by a sharp rebound in semiconductor stocks, and this massive, ongoing optimism surrounding AI companies ahead of Q2 earnings. It's basically AI-driven euphoria. But sharply contrast that with the fairly bearish reality hitting tech across the Pacific. Over in Asia, it is a very mixed bag. Japan's Nikkei actually dropped over 1.2%, and it was dragged down specifically by semiconductor-related declines. So the exact same sector lifting up the US is currently weighing down Japan. Crazy, right? And wow, speaking of surprising Asian tech declines, we absolutely have to emphasize this number, negative 5.6%. That is the massive dive taken by South Korea's KOSPI. It experienced this sudden, sharp, risk-off sentiment in tech and growth names. But what makes this particular drop so wild is that it happened despite incredibly strong guidance coming from Samsung. It just goes to show you how powerful the broader global macroeconomic currents are right now. They're literally overpowering even positive individual corporate news. But hey, it's not all red across the board over there. And this perfectly illustrates how nuanced global markets can be. Indian markets are actively defying the trend. The Sensex and Nifty 50 are definitely seeing some volatility for sure, but it's been a net positive trading environment, extending a multi-day winning streak. And they're doing this entirely on the back of their domestic IT sector. Companies like Infosys and Tech Mahindra are surging over 2.4%. That strategic surge in IT is successfully offsetting the very real weakness they're experiencing in their realty and metal sectors. All right, stepping back for Section 4, the 2026 economic outlook. Let's zoom out a bit from the daily stock market volatility and look at the broader macroeconomic picture heading into 2026. Despite the immense pressure of those high interest rates we were just talking about, the International Monetary Fund has released updates projecting a resilient 3.3% global growth rate baseline for 2026.
That is an absolutely crucial piece of data. It suggests that fundamentally the global economy is holding its ground and maintaining stability, even while absorbing the shock of much more expensive borrowing costs.
But, we gotta keep it real and temper that optimism just a bit. This baseline, it's not guaranteed. The IMF explicitly warns that downside risks definitely persist. The looming dark clouds over this 3.3% growth projection are geopolitical tensions and the ongoing threat of trade tariffs. These are the highly unpredictable variables that could severely threaten the global economic resilience we literally just looked at. And finally, Section 5, Currencies and Commodities. So, we arrive at the last dominoes of our chain reaction. The raw materials that fuel the economy and the currency valuations that dictate the terms of all global trade. Right now, it's basically a massive tug of war happening in the inflation data. On one side, we've got Brent crude hovering right around $72 a barrel. These relatively lower energy prices are a huge positive. They're providing some much-needed relief to global inflation outlooks. But on the other side of the rope, pulling back hard, is that sticky inflation we mentioned earlier. Services and wage inflation remain incredibly persistent worries for central bankers. Cheaper oil definitely helps, but as long as services and wages keep climbing, central banks are going to remain extremely cautious about lowering those rates. And bridging directly into how these policies impact the global stage, we have to talk about the US dollar. It remains notably strong, asserting absolute dominance across global exchange rates right now. Why does this actually matter for us, the average consumer or investor? Well, because a strong US dollar creates a major ripple effect. It dictates global supply chain pricing, it makes US exports way more expensive for the rest of the world, and it puts immense pressure on foreign currencies. And honestly, there is literally no better example of that pressure than this number right here, 162. The Japanese yen is trading near a 40-year low against the dollar, crossing right above that critical 162 mark. The dominance of the US dollar, combined with Japan's own internal economic policies, has pushed the yen to historic lows, fundamentally altering the dynamic of trade between the East and the West. Which brings us to our conclusion, and a very critical question based on that struggling yen. Is government intervention the next domino to fall? I mean, with the yen hitting 40-year lows, speculation is just running rampant that the Japanese government might be forced to step in and actively intervene in the currency markets. From high interest rates to cautious central banks to volatile tech markets and dominating currencies, this chain reaction is well underway. The big question is, how will these global players react as the next domino tips? Thank you so much for watching this explainer. Keep your eyes on the markets, and we'll see you next time.